Last week, the U.S. Supreme Court delivered a major blow to President Trump's trade agenda, sending shockwaves through Washington and the global business community. The justices struck down his sweeping tariffs imposed under the International Emergency Economic Powers Act, a law originally intended for national security threats, not broad economic policy. In a decisive 6-3 decision, the court ruled the president had overstepped his authority, emphasizing that such far-reaching economic measures require explicit congressional approval, not unilateral executive action. The ruling immediately nullified tariffs that had been in place since spring 2025, including a controversial 10% reciprocal tariff on all imports, and a punitive 40% surcharge on Brazilian goods. These tariffs had sparked months of tension with U.S. trading partners, especially Brazil, and led to retaliatory measures abroad. Trump's response was defiant. He publicly derided the justices, calling the decision a disaster for American workers, and accusing the court of undermining presidential power. He vowed to find another way to impose tariffs, hinting at new executive orders or legislative pushes, and rallying his supporters with promises to keep fighting for what he called fair trade. The decision forced U.S. Customs to halt collection of the tariffs overnight, creating a sudden legal and economic vacuum that left importers, exporters, and government agencies scrambling for guidance. For importers and exporters, the ruling was a bombshell, lifting billions in duties that had weighed on businesses for over a year, but also raising questions about refunds and future trade policy. The sudden change sent shockwaves through financial markets and plunged global trade into uncertainty as companies and investors tried to assess the new landscape. Trump, refusing to accept defeat, claimed the ruling gave him even more power by clarifying the limits of executive authority, and warned that the fight over tariffs was far from over. As world leaders scrambled to respond and global supply chains braced for more disruption, it was clear the chaos in global trade was only just beginning. Within hours of the Supreme Court's decision, Trump pivoted to a new strategy, invoking Section 122 of the Trade Act of 1974, a rarely used law. He announced a new global tariff, initially set at 10%, then quickly raised to 15%, the maximum allowed under the statute. The new tariff would take effect in less than 72 hours, leaving businesses and trading partners scrambling. This move sidestepped the court's objections by switching legal grounds, signaling Trump's determination to keep tariffs central to his policy. Legal experts saw it as a bold end run around both Congress and the judiciary. The rapid shift replaced one set of contentious tariffs with another, deepening global uncertainty. Trump's message was clear. If blocked by one law, he'd simply use another. The new 15% global tariff, authorized under the 1974 Trade Act, marks a significant shift in U.S. trade policy. Unlike previous measures, this tariff is designed to be both broad and temporary, with a strict 150-day limit that puts pressure on policymakers and businesses alike. Unless Congress steps in to approve an extension, the tariff will automatically expire in late July 2026, creating a sense of urgency and uncertainty for industries and trading partners around the world. Unlike the previous tariffs, which often targeted specific countries or products, this one applies broadly to most imported goods. However, there are important exemptions that reflect the complexities of global supply chains and the need to protect certain sectors. Exemptions include critical minerals vital for technology and defense, energy resources like oil and gas, agricultural products such as beef and oranges, and essential pharmaceuticals. These carve-outs are intended to avoid disrupting industries that are crucial for national security or public health. Most electronics, vehicles, and aerospace components are also exempt, recognizing their importance to both domestic manufacturing and international competitiveness. Meanwhile, existing tariffs on autos and steel remain in place, meaning these industries continue to operate under previous trade restrictions, adding another layer of complexity. For many countries, the new flat 15% rate is actually higher than the rates they previously negotiated under trade agreements, potentially straining diplomatic and economic relationships. For others, especially those that were previously hit with much steeper tariffs, the new rate comes as a relief, offering a more predictable and manageable cost structure for their exports. For example, UK goods that once faced a 10% tariff now see that rate jump to 15%, making British exports to the US more expensive and potentially less competitive. In contrast, some Chinese goods that were previously subject to a hefty 32% tariff now drop to 15%, significantly lowering the barrier for certain imports from China. And, for products that fall under the exemption list, the tariff can be reduced to zero, allowing them to move through customs without additional costs. The administration argues that this sweeping tariff is necessary to address the persistent U.S. balance of payments deficit, aiming to reduce imports and strengthen the domestic economy. However, critics from both the business community and economic experts warn that such a broad measure is a blunt instrument, with questionable effectiveness and the potential for unintended consequences. The temporary nature of the tariff only adds to the uncertainty, forcing businesses to make tough decisions. Should they absorb the extra costs, pass them on to consumers, or invest in rerouting their supply chains for a policy that might disappear in just 5 months? Many companies are scrambling to adapt, weighing the risks of making long-term changes for a short-term measure and trying to anticipate what comes next. With Congress unlikely to extend the tariff, a major institutional showdown is looming as lawmakers and the administration clash over the future of U.S. trade policy. The new regime is complex, disruptive, and leaves global markets on edge, with investors and businesses watching closely for any sign of what will happen after July. The countdown to July has begun, and the world is waiting to see how this bold experiment in trade policy will play out. The new tariff instantly reshaped global trade, creating clear winners and losers. In a matter of days, the balance of power among trading nations shifted as governments and businesses scrambled to adapt to the new reality. The ripple effects were felt not just in boardrooms, but on factory floors and shipping docks around the world. Mexico emerged as a top winner, exempt under the USMCA, giving its exporters a major edge in the U.S. market. Mexican factories ramped up production almost overnight as American companies rushed to source goods from their southern neighbor. For many Mexican workers and businesses, this was a rare moment of opportunity and optimism. The UK and Australia, who had negotiated 10% rates, now face a 15% tariff, erasing their hard-won advantages and straining alliances. British and Australian exporters, who had invested heavily in building relationships with U.S. buyers, suddenly found themselves at a disadvantage, sparking frustration and urgent calls for renegotiation. Brazil, freed from a 40% surcharge, now faces 15%, but many of its key exports are exempt, making this a net gain. Brazilian agricultural producers, especially in soybeans and meat, celebrated the news, anticipating a surge in demand from U.S. importers seeking alternatives to pricier suppliers. China and India, previously hit with higher tariffs, now see a path to lower rates, strengthening their negotiating positions. Both countries quickly moved to capitalize on the new landscape, signaling their willingness to engage in talks and explore new trade deals with the U.S. China is already pushing for a full review of trade terms ahead of Trump's upcoming visit. Chinese officials are leveraging the moment to demand concessions and greater access to the American market, hoping to turn the tariff shakeup to their advantage. India has paused a planned trade delegation, sensing new leverage. Indian negotiators are recalibrating their strategy, aiming to extract better terms and ensure their exporters benefit from the shifting trade environment. The tariff shuffle has inadvertently empowered America's rivals while penalizing some of its closest allies. As the dust settles, the U.S. finds itself navigating a more complicated web of relationships, with old friends frustrated and new challengers emboldened. The global trade map has been redrawn overnight, setting the stage for a new era of competition, negotiation, and uncertainty in international commerce. Europe's reaction was swift and alarmed. The EU, having negotiated the Turnberry deal for sector-specific zero tariffs, saw its hard-won advantages wiped out by the new blanket tariff. Brussels postponed ratification of the deal, demanding clarity and warning that agreements can't be unilaterally overridden. German and French leaders promised a unified response, hinting at possible retaliation. European Central Bank President Christine Lagarde warned that such unpredictability erodes trust and undermines investment. For European businesses, the question became whether the U.S. was still a reliable partner. The U.S. trade representative insisted deals still stand, but this clashed with the reality of higher tariffs. The UK and Australia, now facing higher rates, felt betrayed. The transatlantic relationship was suddenly on shaky ground. The abrupt policy shift rattled global markets. U.S. stock indices slipped, reflecting investor unease over higher costs and economic uncertainty. European markets fell as well, with fears of higher export costs and the collapse of the Turnberry deal. In contrast, Asian markets, especially China's, rallied, seeing the new tariff as a net positive for their exporters. Gold and silver prices jumped as investors sought safe havens, while the US dollar weakened slightly. Bitcoin dropped, signaling broader risk aversion. The message from markets was clear. The new tariff regime injected risk and unpredictability into the global economy. The world was bracing for more volatility. With the Supreme Court ruling Trump's previous tariffs illegal, a new battle began over the billions collected. Companies are now seeking refunds for an estimated $175 billion in duties paid since 2025. The process is complex. Refunds will require lengthy litigation in lower courts, likely taking years. Refunds will go to American importers, not consumers, even though the costs were passed down the supply chain. This could result in a windfall for corporations, while consumers who paid higher prices get nothing. Critics argue this outcome rewards importers and leaves the public empty-handed. The fight for refunds is set to be one of the most contentious legacies of the tariff saga. Billions hang in the balance as the legal battles begin. As of February 23, 2026, global trade is more uncertain than ever. Trump's new 15% tariff, set to expire in 150 days, has created a window of instability and risk. Allies feel betrayed, with years of negotiation seemingly cast aside. The administration's unpredictability is pushing partners to diversify away from the US. Meanwhile, China and India are seizing new opportunities, negotiating from a position of strength. Trump's upcoming visit to Beijing is now a high-stakes moment. The world faces a future of shifting alliances, legal battles, and economic shocks. The only certainty is more uncertainty.